Welcome to This Explainer. Okay, today we're doing something just a little bit different. We're looking at public sector financial statements, but we're definitely not just reading dry numbers off a page. Nope, we're going to treat these dense, complicated documents like a mystery that's just waiting to be solved. Together, we are basically going to become financial detectives, really digging into the data to uncover the true story behind public funding.
I mean, think about it. How do we actually measure the quality of a government's management? We're talking about the public's money here, our taxpayer money, on the line. When you look at government entities, departments, and parastatals, there is just so much dense jargon and these massive, intimidating spreadsheets. So how do we cut through all that noise to truly hold these entities accountable? Well, the answer completely lies in how accurately we interpret their accounts.
So, here's our docket for today's investigation. First up, decoding finances. Then, spotting trends. Number 3 is the liquidity test, followed by the solvency game, and finally, ratio limits.
All right, let's just dive right into Section 1, Decoding Public Sector Finances.
Now, before we even think about crunching numbers, we really need to nail down what interpreting these accounts actually means in the public sector. It turns out this is considered both an art and a science. It's the whole process of translating raw financial figures to reveal an entity's strengths, its weaknesses, and, this is absolutely crucial, the exact causes of those weaknesses. As financial detectives trying to gauge management quality, what's super interesting here is that it's simply not enough to know that a government agency is bleeding money or carrying a ton of debt. We have to use analytical techniques to find out exactly why it's happening. Because you can't hold the right people accountable if you don't know the why.
Moving right along to Section 2, Spotting Trends with Variance.
So this brings us to our first major investigative tool. This is the part of our investigation where we actively hunt for anomalies by comparing what was promised to the public against what actually went down. To find these anomalies, we rely on a pretty fascinating rule called IPSAS 24. Those are the International Public Sector Accounting Standards Guidelines. And according to IPSAS 24, entities are strictly required, practically forced, to present a comparison of their budgeted amounts right alongside the actual amounts they spent or earned. This whole thing is specifically designed to ensure legislative oversight. It means the original budget, the final adjusted budget, and the actual final amounts all have to be laid out publicly. This side-by-side comparison, that is the absolute foundation for our variance analysis.
When we stack those budgeted promises up against the actual numbers, we're left with either a positive or a negative budget variance. Now sure, a positive variance looks fantastic on the surface. It means actual revenue was higher than expected or expenses were lower than the budget. A negative variance obviously means the opposite. Income fell short or expenses blew past the budget. But remember, we're detectives. If we spot a positive variance where expenses are way below budget, we can't just pat them on the back and walk away. We have to investigate. Did the organization actually find a brilliant, sustainable way to cut costs on an ongoing basis? Or was the initial budget just built on incredibly poor assumptions to begin with? You've always got to dig into the why.
Which perfectly tees up Section 3, liquidity, the short-term test.
Right, so once we've got a handle on the budget variances, we pivot to our next investigative tool, asking a very immediate, critical question. Can this entity actually survive the year and pay its bills today? To figure that out, we use liquidity ratios. Think of this kind of like checking your checking account balance before you sit down for a massive, fancy dinner. These ratios assess an entity's ability to quickly convert its assets to cash and pay off its short-term obligations without any delay or significant loss of value. Federal, state, and local governments use these mostly to measure the ease of meeting current year obligations. It's essentially a real-time health check for suppliers, employees, and local banks who are waiting to get paid right now.
Let's break down one of the absolute strictest liquidity measures we have at our disposal, the quick ratio, or as it's aptly called, the acid test ratio. It's just 2 simple steps. Step 1, you add up only the most liquid assets: cash, marketable securities, and receivables. Did you notice what's missing there? Inventory. We totally leave out things that take time to sell. Step 2, divide that total by current liabilities. This formula brilliantly strips away all the fluff and tells us exactly how many easily accessible liquid assets are available per unit of short-term debt.
Let's actually put that math to the test. We've got 2020 case files for 2 hypothetical entities derived from our source text, the OCO-Comico and Aeronlect electricity distribution companies. If we run the numbers, in 2020, OCO-Comico had 130 million naira in current assets against 110 million in current liabilities. Aeronlect, on the flip side, had 110 million in current assets against 88 million in current liabilities.
And when we run a basic current ratio for Airlay, just dividing their 110 million in assets by their 88 million in liabilities, we get a winning ratio of 1.25 to 1. That literally means they've got 1.25 Naira in cash-ready assets for every single Naira of short-term debt. Okoko Maiko's ratio was only 1.18, so Airlay is the clear winner here. They are in a noticeably better position to handle their short-term liabilities without going into a full-blown financial crisis.
Okay, let's zoom out a bit for Section 4, Solvency, the long game.
Because short-term survival, that's really only half the mystery. We step in as financial detectives here to figure out if these public sector entities are secretly drowning in long-term debt that's eventually going to sink them. We uncover this long-term truth using solvency ratios. While liquidity is all about whether you can pay the bills today, solvency assesses long-term financial viability. It looks at the ability to pay off those massive bank loans and multi-year bonds. This information is absolutely vital for bondholders, institutional investors, and the broader government to see if the entity is actually sustainable over the next decade and not just the next quarter.
Now, what's really interesting here is how we can kind of slice up the financial pie to figure out the debt-to-equity ratio for a hypothetical entity. We take the total liabilities, which in this scenario is 120 million Naira, and we compare that against the shareholders' equity, or net assets, sitting at 150 million Naira. By dividing these two, we're basically asking, okay, how much of this entity is financed by borrowed money versus how much is actually financed by its own equity?
So, doing the math on that gives us a debt-to-equity ratio of 0.80. And honestly, this is a fantastic favorable position to be in. Since it's below 1, it tells us the entity relies way less on outside lenders and much more on its own equity base. It means they face significantly less financial risk if the market suddenly turns sour or if interest rates spike out of nowhere.
We can actually refine this solvency investigation even further by using the debt-to-capital ratio. This formula, interest-bearing debt divided by the sum of interest-bearing debt and equity, is a brilliant tool because it strips out non-interest debts like your regular trade payables. It measures exactly how much of the capital employed actually costs the organization money in interest. And obviously, the higher this ratio climbs, the higher the risk of insolvency down the road, simply because debt servicing is going to eat up all their revenue.
Time to wrap things up with Section 5, the limits of ratios.
Look, we've covered some incredibly powerful tools today, but any good detective knows the limits of their toolkit. Let's do a quick reality check on ratio analysis. On the plus side, it brilliantly simplifies incredibly complex financial statements, and it's practically unmatched for trend analysis and comparing different entities side by side. But we've got to be careful. Entities operating in different geographical or regulatory environments, that can severely impair fair comparability. Plus, accounting standards often allow for different policies, which means human estimates and assumptions can heavily skew the data. But honestly, perhaps the biggest limitation of all is this. Ratio analysis only explains past relationships. It relies 100% on historical data. Which really leaves us with one provocative, lingering question. If these ratios and formulas can only explain the past, what exactly are you going to use to predict the future performance of a government entity? Thank you so much for joining me for this explainer. I really hope this structured look into public sector financial statements has given you the investigative tools you need to see past the jargon and demand true accountability. Keep analyzing, keep digging, and always keep asking the right questions.